Cue the music. Ladies and gentlemen, what an absolute crazy week it's been, and it's only Monday. The S&P 500 down another 0.5 percentage point, tech stocks keep dumping, and tech bulls on absolute life support right now. But with earnings still looking robust and the Ukraine-Russian peace deal coming into focus, what should we do with our portfolios, and where does the S&P 500 go from here? On Friday, I said Monday's close will determine everything. Monday has closed, and it's time for us to put our money where our mouth is. Will we go higher, or will stocks keep dumping? Stay tuned, because that's what we're going to cover here today, as well as Trump getting what he wants, seasonality, and some of the best charts. There are some great charts, and there are some very, very concerning charts. So is this the start of the next crash or the next move higher? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks sold off into the close on Monday as investors weighed the prospects of President Donald Trump's tariff policies, a peace deal in Ukraine, Apple's $500 billion investment, and also a shift in focus to the big player Nvidia reporting earnings on Wednesday. Now, Nvidia was down 3% today, and so was pretty much the rest of tech. Hardware was very, very red. However, there was some green spots if you look very closely, stuff like RTX, Boeing. Apple was also green today, really kind of holding this market together, all things considered. We also saw sell-offs in Microsoft down 1%, Meta down 2.26%, Google kind of flat, but stuff like CRM, Netflix, they were down. There was a lot of red in today's trade, particularly in the technology space and technology adjacent names. Look at stuff like Walmart down 1.17%, Amazon down 1.79%. However, there was some green to talk about as well. Berkshire Hathaway was up 4% on the back of their earnings. Financials was a mixed bag, but we saw pretty green momentum in technology, consumer services, utilities to a degree. Commercial services was actually pretty positive, all things considered. Same here with energy, communication. So there definitely was green if you really look under the hood. However, it definitely was risk off. We also saw the crypto market wiped out $110 billion in total market cap, mostly led by Bitcoin, Ethereum, and XRP. But back to equities, guys, what we saw today was actually just outflows in the Nasdaq 100 as well as the New York Stock Exchange. We saw some pretty dramatic outflows in both of these exchanges to start the day off. We did see a little bit of inflows here, or net inflows, I should say, from the bottom that the S&P 500 made, and then we actually saw a little bit of outflows to end the day, which resulted in the S&P 500 actually just like dumping into the close here. Very, very relentless bearish price action, and the S&P 500 was down 0.5% for the entire day. Now, the best performing sectors, guys, was the XLV, and we actually had more positive sectors today than we did have negative sectors. However, we actually see stuff like XLK, the technology sector, XLY, the discretionary space. These are very heavy hitting sectors in terms of market cap and market movers, stuff like Amazon, Tesla, Nvidia, Microsoft in these sectors, and that is why the S&P 500 was down 0.52%. It was a pretty ugly day. Now, we actually did see quite a rotation under the hood. Now, we definitely saw money move from the movers into some of these sectors. Now, what we saw on Friday was a liquidation, just the market pulling money out. But what we actually did see today was a rotation, and maybe even the market deploying capital in certain names. Stuff like healthcare was up 0.78%. Same with financials, down 0.44%. Our financials were down very big on Friday. They were up today, so there was definitely money being deployed in the financial space in certain names, especially into names like Berkshire. We definitely saw capital move into that. Real estate was down, was up 0.39%, and that's because we did see yields move lower today on the back of everything we saw. Especially when you have the economy weakening, you're going to see yields move lower. That's going to help real estate. We also saw stuff like staples, communication services, energy, and materials all up in the green today. But net guys, we definitely did see the broad indices lose. The S&P 500 was down 0.5%. And this is what the day looked like in aggregate. Large cap growth down very, very big, and growth as a whole took it on the chin. Mid cap growth, small cap growth. However, value core in small caps, mid caps, and large caps really were in the green today. And again, it really goes to show that while on Friday we had a liquidation, today we actually did start deploying capital, and we did see a little bit of a rotation into these sectors right here. Very, very positive when you look at it from a money standpoint and what the market's actually doing. Definitely are seeing some resilience and alpha generation in the broad market. And that was because we actually got a number of announcements today. Number one, Apple will spend more than $500 billion in the US over the next 4 years. So in Donald Trump's campaign, him, Tim Cook, and Apple have come to agreement. They're going to put $500 billion to work in investment in the US. Now, this plans include a new factory in Texas, doubling the US Advanced Manufacturing Fund, a manufacturing academy, and accelerated investments in AI and silicon engineering. And there's going to be teams and facilities in Texas, California, Arizona, Nevada, Iowa, Oregon, North Carolina. So really a lot of money coming out of Apple's pocket over the next 4 years, $125 billion every single year. And it's going to go to the US. And that is a lot of money, and a lot of industries are going to benefit from that. Another market mover was that Trump said the US is on time with tariffs against Canada and other countries, particularly Mexico. And he said this during a press conference on Monday. He had a major press conference. He said tariffs on Canada and Mexico would go forward on schedule after the 1 month delay is over. On that same press conference, Donald Trump came out and made a tweet, and this was regarding the situation in Ukraine. Pretty much him, Emmanuel Macron, as well as Justin Trudeau came together to talk about all things the economy, but specifically the Russia-Ukraine war. And pretty much he said that everyone expressed their goal of seeing the war end, and he emphasized the importance of the vital critical minerals and rare earth deal. This is pretty much a deal where Ukraine will allow US companies to mine rare earth metals in Ukraine. He said that's going to be signed very, very soon. This deal will be an economic partnership to ensure the American people recoup tens of billions of dollars in military equipment and money sent to Ukraine. It's also going to help Ukraine's economy grow as this brutal and savage war comes to an end. At the same time, he's also in serious discussions with Vladimir Putin of Russia concerning the ending of the war and also major economic development transactions. Now, I don't know what that means. Is the US going to get money from Russia? Maybe the $250 billion in assets that was seized, they're going to release those to Russia. I don't know what that means, but there's definitely going to be a transaction taking place between the United States and Russia. And he says talks are proceeding very, very well. So guys, it really does look like we are moving towards a situation where we could actually see a peace deal. We need Ukraine to come to sides. It looks like Russia's coming to the fold as well. Very interesting developments as it pertains to war. The Ukraine, very, very interesting to see. And I am really hopeful for a peace deal. Now, for all intents and purposes, regardless of all of the geopolitical advancements we saw, Europe was very, very mixed. Asia was deep in the red. China, India, as well as Southeast Asia, very, very red. Australia was kind of green. New Zealand was very red. South Africa was red, but what's new? And then we saw kind of a red day here in the US. Canada was kind of green. And then South America, we had a mixed day here in South America. For all intents and purposes, guys, it was just a mixed day globally. But we did have some major market movers. Berkshire Hathaway came out, reported their earnings. They beat on top line, beat on bottom line. The stock was up 4%. They're holding a record cash pile. And there was a ton of dissection of Berkshire's shareholder letter. Warren Buffett paid $25 billion in corporate taxes. That's about 5% of total corporate taxes that America paid. So it's kind of crazy to see how profitable Berkshire Hathaway is as a company. But the market did like their results. Berkshire was up 4% on this news. And Palantir down another 10% today. The stock literally 5 days ago traded at $122, down about 27%. And this all pertains to Pentagon budget cuts anywhere from 8% every single year under Peter Hegseth. We'll see how this is going to affect Palantir, but the market doesn't like it, down 10% today. And I think we're going to continue to see Palantir get reevaluated as its earnings visibility becomes a bit more foggy. When you are trading at 400 times earnings, you need earnings visibility, and Palantir just doesn't have that right now. Now, looking at Domino's Pizza, they were down 1.65% today, down as much as 4%. in the AM. Now, we did see the stock pay a lot of its losses, and that's because it missed on top line, missed on bottom line, but it looks like the street had already priced a lot of this in. We actually saw a lot of buying into the close, but still negative on the day net. Hims and Her Health, now they were up 4% here today, but down 13% on the back of their earnings. Now, just for the record, Hims and Her's earnings were absolutely blockbuster. They beat on EPS, they beat on sales, beat on EBITDA. Margins, however, did miss. Gross margins reported at 77%. The street were expecting 79%. However, Q1 guidance was above Wall Street's expectation. Management said they would do $530 million in Q1 guidance. The market expectation was for $499, right? And then 2025 guidance was for $2.4 billion. The street was expecting $2.1 billion. So we actually saw a double beat and raise, missed on the margins, and the street didn't really like that, so they sold the stock off. But I think these earnings were great, and I think if you can find a period of consolidation, maybe around, the mid 40s, early 40 range, I think that actually might be a buying opportunity because this company is still growing very, very strongly. In fact, their subscriber growth grew 45% year over year. Absolutely crazy. They added 2.23 million subscribers. Just insane growth. I think this growth is going to continue, and I think anywhere from $40 to $45 might be a great buying opportunity. But it really goes to show that the beat and raise, despite being spectacular, wasn't good enough for Wall Street. But I think margins also a factor in that equation as well. But for everything we saw today, guys, market breadth continued to deteriorate. 2,500 advances versus 3,800 decliners. And we saw much of the same from what we saw on Friday. The 200-day moving average holding strong up at the 50% mark, but the rest of the moving average is shorter term, medium term, and even the 150-day not looking that great. Now, the 5-day is a bit noisy, but things still looking very, very ugly, all things considered. But let's hop on the chart. Now, guys, very interesting developments. Now, equities were broadly red, except for the RSP. This is the S&P 500 equal weight ETF. So we're definitely seeing that broad market rotation happen under the hood, but it's only in large caps. Look at the mid-cap indices, look at profitable small caps, look at the IWM. They were down 0.13, 0.42, 0.72% as a whole. So really what we're really seeing is declines in smalls and mids. A broad rotation happening under the hood in large caps. However, the top large cap stocks, look at the Nasdaq 100, down 1.21% today. The S&P 500 only down 0.5%. So definitely a risk-off day. Rotation definitely occurring under the hood. But if tech is not going to participate, you're going to see just broad declines in the entire market. Now, what also did help stocks today, is yields on the 2-year, 10-year, and 30-year yield fell. Dollar was kind of flat, and bonds gained as a result. Bitcoin was down. It was a risk-off day today, and gold was up 0.6%. So there's still that angst under the hood, and the market really positioning themselves in the gold trade. Now, gold is nearly at this 3,000 level. For those of you that are new to my channel, in 2025, at the start of this year, I said we're going to see 3,000 gold, and we are 50 points away from that, 48 points away from the 3,000 mark. And right at the start of 2025, right here, I said 3,000 gold is incoming. Had you put your money when I said that at the start of the year, you'd probably be up, 10%? Absolutely crazy move, all things considered. However, I do think gold is going to reach $3,000, but I do think if we do get a pullback to this level right here, 2,700, I do think you want to buy the dip, and there's plenty of reasons why. I do think Scott Bessent is going to do a gold revaluation. Right now, the US gold reserves is currently sitting at about $40 an ounce. We do know that Trump and Musk are going to go ahead and look at the Fort Knox reserves, do an audit of the overall reserves, and I think Scott Bessent is going to revalue gold at the 2,800 level. That would pretty much make the floor for gold at the 2,800 level, and this would be a deep value situation. I mean, looking 5-10 years out. So gold are looking really solid, especially if we do get the bull case with the revaluation at the 2,800 level. And with the repurchase agreement. You could see $800 to $900 billion added to the US fiscal budget via a repurchase agreement, if that is the case. But let's actually talk about the S&P 500, guys. Now, on Friday's video, I said we have to wait for Monday's close and see what happens. And here we are, Monday's close. But there was a couple of things that happened. I said if we close above the gamma flip, we probably aim higher for the 6105 area. Below the gamma flip, right, we actually aim for this 5880 level. Now, it does look like we actually did close above the gamma flip. The problem here is the gamma flip actually did move down. It was previously around about there. So if you actually look at Friday's numbers, we did close below Friday's gamma flip zone. However, we actually did close above the newly moved lower gamma flip. Now, when the gamma flip moves lower, versus all the core resistance move lower, and that is not constructive. However, the support stayed where it is. Now, it does feel like I'm kicking the can down the road, but I think we actually have to wait for tomorrow's close. If the gamma flip stays exactly where it is right now, which is the 5980 level, and we get a close above, I think this is an opportunity for us to buy the dip. We go to 6105, maybe even new all-time highs over the next couple of weeks, right? However, if we get a close below this level tomorrow, yeah, we probably go to the 5880 level. So that is how we plan it today. If the gamma flip had stayed where it was, we would be targeting 5880. But because the gamma flip moved down, put support moved down, and that means options dealers did get slightly more negative on the markets. So we have to wait and see. So we are still technically in positive gamma, but at a lower strike, and that is often not very bullish, all things considered. So let's wait for tomorrow's close. Below the gamma flip, this is the target. Above the gamma flip, this is the target, assuming the gamma flip doesn't move up or down. Actually, if it moves up, that would be very positive. But assuming the gamma flip doesn't move, then we will know our next target, and that is go lower or go higher. However, when you look at it at a technical basis, this is a terrible candle. This is a terrible candle, and we are at a very, very critical zone right here. You can see the second we start breaking some of these levels, maybe even closing below, we're putting in lower lows, and then obviously that becomes our target. And that is why I say if we close below these levels, we break some of these lows, our target becomes 5880, and then the bulls really are going to need to put in work. Otherwise, when you do zoom out below this level right here, it's a very, very quick drop to like the 5400 level and the 5100 area. But we're not there just yet. There definitely was some positive price momentum. I mean, look at the RSP. It was green today. Look at what's happening in the after hours. It was green. And we did see yields move lower in a very tangible way. The 10-year yield went from 4.7% to 4.4% where it is right now. And that is going to be very supportive of the market. No, I lie. Not 4.7, 4.8%. We're now at the 4.4% range. That is absolutely crazy. We had the 10-year yield at 4.8%, but we are below this 4.5% range. We can then see a spike up. That would be a higher low relative to this. And then if we continue the move down, break these lows right here, that would be a lower low. And then a higher low, lower low. We continue the downtrend and we can aim for the 4.1% range. Nonetheless, let's go back to equities. So you know the game plan tomorrow for the S&P 500. Wait for tomorrow's close. And I know it feels like I'm kicking the can down the road, but wait for tomorrow's close. If the gamma flip doesn't move, we have our direction and we go from there. Buy or sell accordingly. The Nasdaq 100, very similar situation. The gamma flip moved lower. Now, when the gamma flip moves lower, guys, that's often a bearish indicator, and you do want to get bearish. And these are very, very ugly candles in the Nasdaq 100. That is so ugly. Like that's a very, very ugly candle closing at the lows of the day, breaking this low right here. However, we're still a while away from these lows right here, and we are at a critical point as well. Very similar to the S&P 500. Let's wait for tomorrow's close. If it's below, because the gamma flip moved lower, we will aim for the 20,900 level. If we close above, I think we remain constructively bullish into the end of the week. Now, guys, looking at the RTY, not a fun day for anyone invested in small caps. We're officially in negative gamma, and I think we just go ahead and target the 2140 area here in the RTY. We saw the gamma flip move down. Gamma flip was pretty much right there. You saw that move down in a very big way. The core resistance moved down in a very big way. The put support moved down in a very big way. Option sellers not really liking what's really happening. Now, I do think if we get a capitulation low to these levels right here in the RTY, that would probably be an opportunity to buy. You want to buy this very critical you want to buy this level right here. However, we did see quite a lot of buying. Look at that wick at this level right here. So we may not get really to this level right here. However, if we do get a capitulation low, we want to buy the 2140 area. But don't be surprised if we actually see buying at this level into the gamma flip tomorrow, just because we found support here on multiple occasions. This is a very critical level for us to make a move higher in the middle of the negative gamma zone. Now do remember, guys, in negative gamma, dealers buy into strength, sell into weakness, and that's why we can get this capitulation move here and then up very, very quickly. That can happen, and that's why we can also, if we do see strength early in tomorrow, we can make a move up very, very decisively. However, we do have to follow the game plan, and we are in negative gamma, and that means our target is 2140 in small cap. So, the market not really looking too favorable towards small caps. But look, in an environment like this where we are right now, there's a lot of uncertainty. Earnings visibility looks very, very foggy. You don't really want to take the risk with higher beta, especially for a trade, because anything can happen. You can get stopped out. You really want to put your money to work as a trader in some of these less volatile indices, stuff like the S&P 500 and the Nasdaq 100. Unless you're like a really long-term investor, in which I think this is a great place to buy, hold 5-10 years down the track. You're going to be thanking yourself you bought the Russell 2000 at these levels right here. Now, guys, let's actually talk about some peak to trough drawdowns in these indices. Now, this is pretty much all-time highs for the Russell 2000, slightly below all-time highs, and we're at about a 12% drawdown from those highs. And if we actually look at the most recent high right here, we're at about a 6%, it's closer to 7% drawdown. So this is great opportunity. Generally speaking, I say every 5, 10, and 15% drawdown, you want to add exposure to an ETF or stock. That's how you make sure that you're buying at incremental levels, because generally stocks will always recover. And when they do, they recover very, very quickly. Now, that is the RTY. It's looking very sluggish at the moment. A lot of consolidation happening right here. Now, the S&P 500, guys, I feel like the world's falling apart. But if you actually just look at it from the peak last week to where we closed today, that's only a 2.7% drawdown. Only 2.7%. So even though we have this high impact news cycle, it actually hasn't been that crazy. This is still a garden variety pullback for all intents and purposes. Now, the Nasdaq 100, the drawdown is a little bit more pronounced. However, we're looking at about just under 4%, 3.96%. And again, it's less than 5%. And it's nothing really to be concerned about. Markets have pullbacks. Pullbacks are very, very healthy. And I think with earnings set to grow this year and 2026, you want to take advantage of these dips, especially if we do go lower. So guys, you know my stance. If you're a long-term investor, buy the dip. I do think we're going to go higher, and I think earnings is going to grow for the next decade. If you're a trader looking very, very short-term, wait for tomorrow's close, and then let's take a position higher or lower, above or below the gamma flip for the Nasdaq 100, the S&P 500, and then the RTY. I wouldn't really trade this right now. I don't really have any skin in the game. We could go higher or lower from here. I don't really like what I'm seeing in that. But long-term, guys, looking towards the end of the year, end of next year, buy the dip.
Diving into sentiment, this is the weekly poll, guys. And this week I posed a question: how are you feeling for the S&P 500? Are you bullish, bearish, or neutral? And we are finally starting to see a change in sentiment, where previously these polls were close to 51% bullish. They are now 51% bearish, and only 32% of individuals are bullish. So it really goes to show we've definitely seen an overall turn in sentiment. More people feeling bearish than bullish, and not many people here in the neutral camp. And guys, sentiment is this self-fulfilling prophecy where bearish sentiment brings in more bears, and more bears lead to lower prices, and the cycle goes on and on and on. Now, lately in 2024, we've actually seen Mondays and Fridays have been pretty bearish. Annualized returns so far for this year, negative 42% and negative 86%. And we're seeing pretty positive days here in the middle of the week, Tuesday, Wednesday, and Thursday. And guys, all of the volatility we've seen so far, it's actually kind of normal here in the month of February. If we look at seasonality, what we normally see is from about the 15th and onwards, we actually normally see lower lows and lower highs, where we actually see the month of February return a negative figure since 1950. So yes, we are seeing volatility, but it's actually kind of seasonal. When you look at the bigger picture, more often than not, periods of indecisive market action, like what investors are currently witnessing right now, have generally resolved quickly. And by quickly, we mean within 2 to 3 months, and typically more robust gains followed, as you can see from this data right here by NDR Research. So if we continue to be in this very tight range, anywhere from 0 to 5%, do take into consideration that that's likely going to resolve higher to the upside, especially if we continue to print earnings figures like we have so far in Q4, up 15% when the market expectation was for 9.7% coming into this earnings season. If you exclude energy, you're looking at about 20% earnings growth for this quarter, 5% in revenue growth, and we have here 76% of S&P 500 companies reporting above analyst expectations, but only 16% reporting below. But what's really, really key is actually the revenue figures. 64% of constituents reporting above revenue consensus estimates. And with the earnings picture this good, it really tells us that the macro, at least the macro in the last quarter, was really good. However, there is some risks we do need to be aware of. Now, Bank of America, who called fourth quarter GDP, started tracking first quarter GDP at 2.3%, as you can see right here, guys. And that's a little under the consensus estimate, 2.5%. So if you see a 2.3% GDP figure, which is slightly weaker than what we were expected, that is actually normal, and that is kind of the consensus right now. And in the past few days, what's actually lowered GDP from the highs has been stuff like business inventories and industrial production. They've all detracted from the GDP figure. But all in all, we are looking at a weaker GDP print than what the consensus was estimating coming into this quarter. And that can be a little bit of trouble, particularly for equities and earnings when Q1 comes around. However, there is a couple of things. Even though retail sales has weakened, it's still strong regardless. We're looking at about 4% here in retail sales and food services. And then also when you exclude motor vehicles and parts dealers, because they tend to be one-off very big expenses. So, and what we're also seeing is that if you look at liabilities as a percentage of assets, it shows that households are in some of the best shapes they've ever been in years. Almost every income group is significantly less levered relative to history than in any other time period. And that's very, very healthy when you look at the broad economic picture. However, US consumer confidence has actually fallen quite significantly. We missed expectations in the last couple of prints, and we're sitting at about the 65 mark, still well above where we were right on the Trump election, but we have seen this trend move down. However, CEO confidence has actually tracked up here in 2024. You can see here when we had the Trump election and he won, CEO confidence spiked up in a significant way. Now, the reason why we have this divergence actually has to do with how they actually track the consumer confidence. This is the Michigan survey, and here's Tom Lee explaining why that is the case.
So you're not concerned about some of the data we've gotten? I mean, that University of Michigan consumer sentiment reading this morning in particular seems to have spooked investors, given the fact that it cited broad declines across age, income, wealth groups. You also said that big spike in year-ahead inflation expectations. That was unchanged, but the 5-year expectations moved higher, too. At what point does that start to manifest into something more meaningful in terms of a slowdown here in growth?
Well, these inflation expectation surveys matter to the Fed because they are concerned about whether or not consumers are actually raising their inflation expectations, and that would in fact be bad. But we have to keep in mind the UMich surveys do seem to be polluted by political affiliation. When you break down respondents by Democratic responses, they've gone from seeing inflation under 2% before the election to over 5% today. Republican respondents have gone from 4% to basically zero. In fact, if you look at the distribution of responses for those Democratic respondents, almost 7% think inflation is currently at 25%. So I think that there is a lot of pollution in that data, and I think it's probably pretty typical what happens when there is a change in administration. But I hope the Fed is aware of that political dynamic.
Now, looking at earnings for the rest of the week. Now, on Thursday, guys, we have Nvidia, and that's pretty much it. This is what everybody is going to be looking at. However, we do have quite a number of names before we actually get to Nvidia. Now, tomorrow, Tuesday, we have before the open Home Depot. That's the biggest name. Scotiabank and Krispy Kreme are also reporting. American Tower. As well, after the close, we have Carver, AMC, Axon, First Solar, Lucid, Cart, Lemonade, Workday, Intuit. So very, very star-studded Tuesday after the close when it comes to earnings. So a lot of like software names reporting here after the close. Do be prepared for volatility in the tech space, particularly the higher beta names. And then looking at data tomorrow, guys, we don't really have much of anything. We have consumer confidence, and then we also have a couple of Fed speakers, but the real market moving data comes on Thursday and Friday. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.